20 years plus of my life investing poorly in my 401k. If I had invested like this when I was younger, I'd be set. I mean, I wanted to have something one day. That's like 10 years ago. And, I went from that all the way to the 7-figure club. Now, to be honest with you, I started off originally with just like $20 a week. And then I went up at one point to like 10% of my income. And then I cut it back. I dropped it down to $50 a week. So I really was not even like doing nothing that, fantastic. It is great to look in your account and see like $1,000 worth of dividends being dropped in it in a month. And then it says like within a year, it's going to be like 150K. I mean, I don't have to work at that point.
Welcome back to another go-round worth of Masters of the Market. This week, I could not be more excited to have on with me Michael Brownstein. He's a fellow Blossomite, if you will. We spoke on Blossom, and I couldn't help but bring him on to Masters of the Market. He's in the 7-figure club and did it all with investing into index funds and more recently, income-producing ETFs. So, Michael, welcome to Masters of the Market. I'll pass you the first question and just ask you about your story and how exactly you got to where you are today.
My story started with investing when I was probably about 21 years old. I bought 40 shares of Walmart stock. And back then, I believe I had to pay like $50 in commission just to buy it. And I had to sell it. I ended up having to sell it. I needed the money at the time, so I never really held it. But that was my first time dipping the toes in the stock market. I got into it the next time through the 401k through work. I went down to the meeting. I was all excited to get into this 401k. And I asked them, what should I put my money in? And there's like, oh, we can't tell you that, But they gave me a list of funds. I'm looking through them, and I see one that says balanced. I asked the lady or man or whoever, I don't remember, but I said, what about this one? They said, oh, yeah, that'll be all right. I literally, had this balanced fund. I never really made a lot of money, even though I was putting money in that, every week. But I would hear about people making money. Fast forward, like over 20 years went by, and I just really didn't have much money, not to speak of, not for that amount of time and my age. I believe at the time I was 44 years old at the time. I'm 54 now, so that was like 10 years ago. And back up for a second, in about 2000, they had a class where I used to live on stock market investing. So I went and took this class. When I took this class, I met this guy there named Bob. And he was an entrepreneur. He became like a mentor to me, but I still had this poorly invested 401k. So I went to his house one day, like around 2015. He's showing me how to trade options a little bit, covered calls and things like that. And he has this book on the table. And I'm saying, Tony Robbins' money book? Like this guy's the motivational speaker. I'm like, he knows how to spend money, but what's he know about money? And this guy says, no, Mike, man, this is really a good book. And he recommended me reading it. I read this book. I was like sad and shocked at the same time. I had spent like 20 years plus of my life investing poorly in my 401k. Like some of the ideas I took out of this book is like index fund investing by Jack Bogle and things like that. They actually had a meeting. They actually switched 401k companies back then. I tried to get my money out and they wouldn't let me because I was just going to put it in an IRA and invest it myself. I went down there, told them that, and they said, well, we can't do that, but they had an S&P 500 index fund in this 401k. So I dumped everything I had into it at that time. And the market happened to go on a run around there too. And I was like, I'm starting to get returns here, like real returns. And I'm making money for the first time. It doubled like in no time, a few years it seemed like, especially about 4 or 5 years, it seemed to have doubled. And I was like, man, this is like crazy. And so I was sick because I was like imagining like if I had invested like this when I was younger, I'd be set. But so I have to thank that Bob, for introducing me to this book. Like I said, I'd recommend reading it. It's a great book. So that was kind of like where I got my journey first started. When I went to the stock class that I was telling you all about, they didn't really talk about index fund investing either. They would like show you like, well, look up on Yahoo Finance, and they talked about futures. So like if you wake up in the morning and they're green, like it should be a good day, or red, it's going to be a bad day. They showed us how to read charts, just basic chart reading and things like that. I started buying single stocks back then a little bit, and I never had any success, truthfully. I'd make a little bit, lose a little bit, but nothing until I got into the index funds. Like zero. The index funds have been like saving grace on everything. that's kind of like where my story first started. Like one thing I did get out of this class though, they talked about the rule of 72. So you take this number 72 and you divide it by your average return, then be about the number of years that it takes to double your money. So like, for example, if you have a 10% return and you divide that into 72, it's about 7 years. And I believe I Googled it earlier, like last 10 years, I believe the S&P's done about 12%. So it means your money's doubling every 6 years. And that's just like passive, not doing anything. So that's like where I invest the bulk of my money is in index funds. And it's in an IRA. In America, you gotta be 59 and a half to get into these IRAs. And I'm 54, so I got like 5 years. I'm gonna let that grow. And then eventually I may convert it into covered call funds and just have, huge amounts of income. That's what the game plan is for right now.
Most investors, at least from all the stories, that I've been fortunate enough to sit through on Masters of the Market, a lot of them will look at their 401k and say, yeah, it's good. And then they'll carry on their way for quite some time. Now, you did have that time where you were, kind of just working and investing into the 401, but eventually you kept circling back and had to change to the S&P 500 within the 401. I'm just curious to know, like, what really got you motivated to start taking on and investing by yourself and switching the funds? Like what even got you to check your 401k again to revisit that decision with the balance fund?
I just heard of people making so much money on theirs. Like they were talking about doubling theirs and mine was like, I don't even know if I made money on it. Time they took out the fees and everything. I'm probably getting like a 5% return. It was pitiful. For like years like this. I wanted to have something one day, and I'm like, back then, I'm like 40, like I said, 44 years old. So that's like 10 years ago. And, I went from that all the way to the 7-figure club now. Definitely a lot of good tools these days, like YouTube. And this Blossom's a great tool I just recently got into. I can see people's portfolios. And I do like the S&P 500 overall. Like say if my daughter asked me, Dad, what would you invest in? That's what I would tell her, just flat out, tell her just to get an index fund because that's been the most success for me at this point in my life.
Now, you kept it incredibly simple. Just index funds. Now, you did have some time where you were investing in individual stocks and your experience wasn't so great. Do you think that's most investors and we're fooling ourselves almost? Like we should just stick to the S&P or we should just stick to index funds because picking these individual stocks, let's be real, most times we're not going to pick the winners 100% of the time.
Well, at my job, when I wanted to get this money, the owner's son told me, he said, I'd like for you to have your money, because it's your money. And when I wanted to get it out of the 401k and put it in the IRA. But he told me, he said, Michael, I learned a long time ago, I'm not good at picking stocks. And this is like a millionaire guy telling me this, so that kind of always stuck in my head. I'm like, this guy's got friends that are in the know and everything and things like that. And there are people that hit home runs with stocks. Like, I'll give you an example. My mom, I help her manage her money. She tells me, like, one day, she says, I want to buy this Palantir. She's seen it on TV. She gets in it for like $10 a share, and I end up selling some options against it, and we get called out. But we bought back in, and we never touched it again. She's up 450% on it. But I don't feel like I'm that lucky overall. So I want, like the Jack Bogle says, I want my share of the market. So, I'm sticking with the index flat out. I got a decent amount of Bitcoin, like IBIT, through BlackRock. And it's actually, besides the S&P, it's been my biggest return on investment. I got it when it first came out. And last time I looked, I think it was like up 160%. And that's like, I believe it was like January or February of 24. So that's huge. The only reason I did that is me and my wife were talking that people are always talking about these huge predictions. God, if they're right, I want a part of that. That might be my lottery ticket. But if I lost 10% of my portfolio, it would be terrible. But the rewards, weigh the risk, I guess, is what I'm trying to say. For me,
go back for a moment
tolerance.
to the 401k. How much money when you when you looked again into the 401k and saw that they were in the balance funds, how much money was in there at the time? And when you made that decision to switch, how quickly did it take you to actually become, or hit rather, the seven-figure club?
I started out with 150K, right around there, give or take some. And I did get a little bit lucky. They pulled the money out for like 2 weeks before there was a lag. And they pulled it out at a high, and the market kind of went down for that 2 weeks. Pretty good too. So I did get a little break when they bought back in, because I got some better pricing. I had over 300 by 2020 for sure.
Like handful of years later here, we're sitting on seven figures.
It's probably about 600 on that particular account, but I do have seven figures because I've got, I guess, a taxable account. That's what you would call it.
So
but yeah, when you add it all up, it's that.
How much money did you start to throw in on a monthly basis? Because again, a lot of people, you'll hear people, late 30s, early 40s, mid 40s, they're just starting to think about investing and retirement. It's kind of like that, oh shoot moment, I need to get started. Most of them don't have 100, 150,000 in there. Maybe some of them who did similarly to you hit the balance fund option within their 401k, maybe they do have that. But when it comes to your investment journey, you start really, sounds like, aggressively investing. So how much did you start to throw in every month to kind of catch up to where you feel you should have been?
To be honest with you, I started off originally with just like $20 a week. And then I went up at one point to like 10% of my income. And then I cut it back because when the market crashed in 2008, the economy had crashed, I dropped it down to $50 a week. So I really was not even like doing nothing that, fantastic. I had like 150K for like 22 years worth of investing. And they didn't even match. So it was just like, the money that I had saved, this compounding effect just like blew me away, because like right now in that one fund, the way things are going, like in 5 years, it'll be $1 million too, the IRA. That's pretty darn good to me, I think, just to double your money every 5 or 6 years.
It's really the magic of the market working in your favor. And so after you started investing in individual stocks, you have this quick realization that that's probably not going to be your path. Stick to individual or ETF funds, rather, index funds. How many did you go after? Did you build up this portfolio of a handful of index funds? Did you just stick to the S&P? What was the approach?
At the time, when I first took over, if I remember right, I put like 2/3. I put all of it but 100,000 in the Vanguard VU. And then I bought kind of like a growth deal. And I had those that's all I had. I did buy a little bit of Tesla, like $10,000 worth, and I ended up selling it for like $19,000 eventually. But one day I got to thinking about it, and I'm like, I'm just going to take all this money and put it in Vanguard VU and just, go with it. And the reason I went with the Vanguard VU at the time was because of the fan of Jack Bogle, and he was the founder of Vanguard, and I just like the original, I guess. And it's done well. That's all I can say.
To say the least. I'm a huge fan of your approach because of its simplicity. In my reality, I see a lot of investors, and sometimes I really ask myself, like, are they really investing here, or are they gambling? I'm curious to get your take. When you take a look at, say, Blossom, and you see everybody talking about picking individual stocks, what comes to mind for you?
Well, like I tell you, like that owner of that company's son told me that time, said, Michael, I've never been good at it. And to be honest, I'm not good at it, truthfully. I did hear something one time. I was talking to this financial guy. He told me something. He asked me how I invested. And I said, S&P 500. He said, well, why not just invest in the top 10 in the S&P 500? He was telling me this around 22. And I kind of like in my mind think back now, like if I just took like 100K and split it, 10, pieces of the pie, I would have probably been better off, probably, because all those, Nvidia, Facebook, everything has really just taken off, Microsoft. I just don't want to, I want to retire eventually. And so I don't want to take any risk. But that seems like that would have been a decent approach as well.
But do you look at, like, for example, the Blossom community as you're scrolling down the main wall, which, by the way, everybody out there, if you don't have Blossom, link down there in the description, an incredible community to be a part of. But when you see everybody chatting about individual stocks, do you want to comment hey, just go for the S&P, keep it simple?
For sure. Like, okay, say like if you buy an individual stock, say you bought $100,000 worth, right? And it went up 40% this year, you'd have $140,000. But then next year it dropped 30%. You would actually be in the hole. I mean, you would have less than you started with. I'm going to live and die by the index. I mean, it's just that simple. I do have a portfolio that's full of covered call funds. Most of them are based on the index as well, and some Bitcoin.
Let's talk about that fund, or that portfolio rather, real quick. How many positions are in there?
I believe there's 16. I share it on Blossom. Like you said, that's a great community. Just look it up, Michael Brownstein on Blossom. You can see what I'm invested in and the percentages and everything. But I've got like several, they're based on the index, but I want to get the income off of them. I don't plan on working that much longer, maybe a few years if I'm lucky, especially if those projections are right. Because like right now it's showing me over 60K. Basically like $280,000 portfolio. And then it says like within a year, it's going to be like 150K, like a 12, 13 months. I'm like, I don't have to work at that point. I can just take out what I need to live on and reinvest the rest.
So with that said, the income funds are rather new because you're closer and closer to retirement. I'm curious to know from your standpoint what you actually think about income investors who are investing in their 20s.
I do follow like a lot of YouTubers, Adriano on passive, I believe it's passive income investing. That's all it appears that like they're in, but I'm sticking with the index for the bulk of this growth until I get to a certain age. If I was younger, I probably would stick with the index the whole way until I got ready. But they got great tools out these days. You can compare some of these index-based funds that pay monthly and weekly income. They're not that far off the index in total returns. I just don't want to like sell, say like if the market was to go down, okay? And I'm having to sell these funds at lower prices to live on. I plan on selling some of them out at higher pricing and converting them at that time and just drawing the income. Like some of these funds paying like 12, 14% a month for each $100,000 block. Say you can get 14 grand. That's pretty good as long as the NAV doesn't erode too much on them.
I see, at least from where I sit, when I start to talk about people's investor profile, how old they are, their investment timeline, what they should be investing into, accordingly. And I see a lot of these younger investors that just want the income now versus capitalizing on that growth like you did to then switch to income when necessary, per se. On the other end, I do recognize that, hey, if you're making money, you're making money. Someone might have the goal to live off of, dividends and passive income much earlier on. But I'm just, and you even shared if your daughter came to you and said, what should I invest into? You said the S&P 500. So just directly, are we fooling ourselves, the younger investors out here, not just investing in the S&P? And keeping it that simple?
There's always more than one way to skin a cat, I guess, as they say. The best I can tell is you're not going to outperform the underlying over time, but they're getting pretty close. Usually what I like is these NASDAQ-based funds for the covered call. I do have some S&P ones as well, and then I got some higher yielding ones that are, quite a bit more risky. I've dealt with that firsthand too. Seen my NAV drop pretty good, Like I got paid $500 one time and lost $300. So I'm like, I'm still ahead, but it doesn't feel good, so.
Let me ask you this in terms of a strategy question. If you had to go back and do this investment journey all over again, I'm sure you wouldn't invest into that 401k. You'd probably want to take it over by yourself and invest accordingly. But how much money would you say is almost the ideal foundation to lay with the S&P 500 before somebody should move on to testing the waters with individual stocks or other funds?
I'd probably try $100 a week, which is $5,000 a year, and just let it compound for years. Just drip it and the dividends off of it, and that's what I would have done if I was talking to my younger self. I also believe that I would have put some of it in the NASDAQ as well because it does seem to outperform the S&P, at least in the last 10 years, a little bit. I would definitely have done that, but when I like something, I just like it. And whatever works, I just, been sticking with the basic S&P 500. Anybody I've ever known that's done that over time, if you have a long enough window, even if it goes down, you'll do well.
Now, $100, every single week, if someone can afford it, or even pushing that out to a month, if you really can't afford $100 a week, once you establish that S&P position, I call it a foundational position. That's also how my portfolio is built. The largest position is the S&P itself. You can't lose that way. But how much money should be in the S&P before you move on to, say, the NASDAQ or an individual stock like a Tesla play, if that's what you want to do?
As long as you know you're going to have $1 million when you're around 50s, just with that, then branch off and play around a little bit with some Bitcoin or some individual stocks, things like that.
So that's almost like just be forward thinking, use calculators that we now have, on a lot of these different financial sites, or, even the rule of 72. How long is it going to take you to actually work your way up to pass that $1 million point? I want to touch a little bit on dividends and income, and it never got you. The dividend bug never got you. The income bug never got you to veer away from the S&P and start income investing earlier?
I would say probably less than 2 years I've been in the income funds. I had some cash sitting around, and I believe I've heard you say cash is trash before. I'm like getting like 4% or something, and I'm like, I can do better than that, So, but I was actually selling options on some of that money, like this on S&P. Like I'd trade them on the SPY or QQQ, etc. I'd get like 1% a month or something out of them, trading myself, and I'm having to spend time with this. These days, they got funds that do it for you. They're not scared. Like if I get emotional about it, I may not trade that, and I put them in these funds and I let them do the work for me. And so that's the reason I got into the income, is to outperform the money markets and stuff.
So you think it's worth having a reserve, a cash reserve as well? Of course, you have your savings, but is it worth it then to almost time the market, or is it just dollar cost average? Just stick to a game plan. Don't seek out dips or just stay the course.
I do like the dollar cost averaging deal, but yeah, definitely it's always better to buy on red if you can.
Well, let me ask you this. Why do you think so many investors overlook such a simple approach?
I think they just want to hit home runs, and me too. I'd like to hit a home run, but it's, what I was in wasn't working, and I have bought some individual stocks before, and I personally have never made any real amount of money until I put it in index funds. I'm not saying people can't, and people do make a ton of money. I kind of think like in the Jack Bogle book, they talk about getting your share of the market, and I just want my share. Maybe I kind of joke about it. Maybe I'm just not smart enough for that, so I want the basic approach where I'm guaranteed, at the end.
It's said that the greatest dime piece of wisdom is actually knowing that you don't know. I also don't know, and the reality is, I think a lot of us as investors, we want to think we know. And many times we find that that simple approach is what ultimately wins out. Buffett and Munger always sat there, on those investor days and said, this is the simple approach that will get us all to millions. But don't outsmart the system. What would be one or two pieces of advice, if you were to sit with your younger self, you would share with yourself?
I believe I read it online before that, like Warren Buffett said that when he passes away, that he'd like for his family to put their portion like 90-something% in something like a Vanguard VU, and then the rest in some kind of cash type asset. He's recognized as one of the best of all times, and so that's good enough for him. And then I've also heard they had a contest one time where they were taking all these hedge fund managers, and they were going against the S&P 500 over like a 10-year period, and they couldn't beat it. The S&P 500, that's your top 500 biggest companies in America. So you got your Microsoft and Apple, Tesla, Coca-Cola, everything. And they keep putting more and more stuff in there, like Palantir, everything. So you're getting a little piece of it. And the way I look at it, I thought about this before. This hypothetically, because I'm not sure on the number, let's say NVIDIA is worth 6 or 7% of the S&P 500. Well, say if you got $500,000 in there, then say you got 35,000 in NVIDIA by itself, if you look at it like that. Those ain't exact numbers because I don't have them in front of me, but that's the way I'm kind of, looking at it. So you do have huge chunks of money in these companies. It's just, you don't have to pick the individual one and have one and go wrong one time and draw your account down.
I think it's a phenomenal outlook. I don't think we think about it like that as often as we should. Mike, let's say an investor who's mid-40s or just entering their 50s comes around and they did not do what you did. They didn't get their head in the game soon enough. but they need to start, how would you tell them to proceed?
That's a great question because it does take time in the market. Instead of time in the market, put, time in the market. You probably would have to take some gambles at that point, maybe try something such as a Bitcoin or something. Say like if they did go up like some of the people are predicting like 10, 15 times, that would be phenomenal if they're right. But yeah, definitely start when you're young. I mean, there's so many resources out there like your channel and many others. But yeah, I do believe index fund investing is king.
What would be some of the top resources you would recommend to some of these older investors who are in need, severe need of starting now, but need the help to get there?
YouTube would be a great one to start with. I mean, there's some really good resources on YouTube. And a lot of these people, they'll show you what they're invested in and how much they've made. And that's YouTube. The Blossom's also great. You can see people's portfolios and it shows their percentages of gains. Like those two are like really good. And then they got like a lot of tools you can just look at too to compare total returns. Like if you're interested in a fund, I believe it's like Dividend Channel. You can put a little bit of your, you can say you can put your fund up there and then compare it to the S&P and it'll show you how close it is to it. So, I mean, the resources are like huge. A lot of these channels like on YouTube, like Spencer Invest, he always shows like, hypothetically, if you put $10,000 in this and 5 years from now, it would be this. And so it may not exactly be like that, but it shows you what could be possible. So there's a ton of sources out there.
And sometimes, honestly, that's all it needs is, what could be possible. Someone needs to just understand what it could be, at least to get started. Now, when it comes to spending, I mean, you had the money to spend. You had a job. You were saving money. You were then investing money. How much of a role did that really play in your journey? And did you have to rework a budget? Did you have to reevaluate how you were spending money?
I'm going to change the story up just a little bit, tell you something that happened to me. When I was 49, so that's like 5 years ago during COVID, I decided to retire from my job. And it had no pension or anything. And I decided I was going to trade options. And I was going to take the money I had, but I didn't really have enough capital like I thought. And I was going to give myself like a $500 a week budget to live on. And I found out that it's not that easy. And I was going to actually start eating up my money that I had saved over time. I was spending more than I was making. And I could sell options at the time and make like $1,000 in 1 week. Being a rookie, I didn't understand implied volatility. Then the next week I'd make $200. Then sometimes I would actually lose money. I did go back to work, decided to give it a few more years. And then over time, they've developed these new funds and they're coming out every day. I believe now that I could 100% retire if I had to. Just live off these covered call ETFs and stuff.
Now, it seems you're becoming a bigger and bigger fan of the income ETF funds. And I know they're definitely here to probably stay for a longer term. But do you think they're more trendy than not right now? And everybody's just jumping on the wrong train in terms of the trend?
I think they'll be here for many years, especially these income-based ones that are on the indexes, NASDAQ and S&P. But they have some, I do have a few smaller ones, positions like on individual stock ones, that they have a higher yield, they have a higher risk as well. I think they're going to get better and better. And in my opinion, and I believe they're going to have more and more products, possibly leveraging some of them like with small amounts of money, percentages, maybe like 25%. Things are just going to, improve over time. I still believe that it's going to be hard to beat the index.
Now, how did you go about picking the income ETFs that are currently in your portfolio?
I looked on YouTube and I found Adriano. And then I bought small amounts of them at first. And I was like killing it on them. Like, actually, I think I might have been outperforming the index at the time. But then when the market crashed down recently, I gave up all those gains. And the fund I was in didn't really come back like it should have. But I had many of them, and they seemed to perform pretty well for me. And so I ended up keeping those and selling the other ones and putting a lot of money in the ones that have been performing well for me. So it was like a trial and error, I would say, because I noticed some of them held up better when the market went down. So the down market is something, that really surprised me.
Did you have any key indicators that you used when you picked these funds, or, what green flags did you have and red flags when you were building upon this S&P 500 position?
I like the ones that do the index, and also the mechanics of the ones that some of them stagger their calls when they sell them, where they might go out like 2%, 4%, 5%, etc., like that, like a ladder approach. So that way you can get some of the upside. And they even got some funds, I've got a lot of them. They got some that keep 75% in the market, I believe, and let 25% of it just run. I mean, 25% they cover it, but 75% of it's running with the market. So you still get income, but they pay less money. Maybe they'll pay like 10% instead of like 14, but you get more market upside. I guess to answer your question, trial and error, just actually buying them and watching how they stand the test of time, I guess.
Let's get down to money. How much income are they actually producing for you on a month-to-month basis right now?
About $5,000 a month. I actually got a pretty decent size of one of the covered call funds in my IRA as well, just to kind of like start a position in it. So I do get income in that. I get about $5,000 a month, my cash portfolio, and it's less than $300,000. So
$5,000 a month, and I've had now a plethora of other investors on who are very excited about the income funds, and they are exciting. They produce income for you. Depending on your goal, like I always go back to, it's incredibly important for some investors. I'm just sitting here thinking, okay, if we know they're working, there are good funds out there. We have the guys like Adriano, he's always brought up, and he's even been on Masters of the Market as well, talking about his strategy and his approach. So we know that this works. Why shouldn't we all be going for this passive income strategy?
I want to go with what brought me to where I'm at. I may be wrong, but I do believe the index funds will outperform these covered call funds over time, unless they leverage them or something. It is great to look in your account and see like $1,000 worth of dividends being dropped in it in a month on one position. I got one of these Bitcoin positions. I think I got $1,300 last week on, and then you get some that pay like $20 a week or $40 a week, but they add up.
So I've been asking a lot of people who jump on Masters this question. I'm curious to get your take on it. I myself have positions in my portfolio that are individual stocks, dividend payers. But is that approach dead and gone? I mean, with now these funds that are just paying yields 10+%?
I'm not going to say they're dead and gone, but for me, they never existed. I always seem like the index always outperforms them. So I stick with the index. I know it sounds really simple. I mean, results are proven over time, for sure. And I think that, like, when you talk to younger people, like, they don't see the big picture. Say if you put $500 a month in an index fund, and then in 30 years you could have $1 million. You're like, oh, but that's 30 years. I mean, I'm 54, and I started working, full time when I was 18. That's 36 years. It's gone. It works. That's all I can say. It's worked for me anyway.
It's certainly the tried and true approach to investing. Now, when it comes to that tried and true approach, regardless, we're all susceptible to market risk, right? When the market gyrates, we get these downfalls, these dips. Has that ever spooked you away from investing, or because of your approach, it just keeps you in the game and it's really just a shoulder shrug?
I've thought about this before. So let's say I pick an individual stock, right? It goes down, it crashes. I have no idea if it's coming back. Zero if it's coming back. But I feel very, very confident that the index is coming back if you have enough time on the horizon. That's the reason I love the indexes, because you don't have no guarantee that individual stock's coming back. It's just that, there's no, even companies that have been around for years and years, proven track records and everything, they drop, and then they don't come back because, evolution, time changes everything. What was in the S&P 500 today, 20 years ago looked different.
In other words, what we're really talking about here is you sleep well at night. You don't have to worry much. Keep the strategy as simple as can be. So in that case, where most of us then are seemingly going wrong is being very emotional when we're investing. Is there a way for all of us to kind of navigate through those emotions?
I've done it myself. I've panicked, or I've either panicked, or I've looked at positions that I've had that just didn't take off like for years. I had Palantir at 17, and I think it's like over 160. And this was just a few years back. If I was going to play with individual stocks, I would probably keep it down to 10% or less.
Now, over the span of time, 30 plus years as an investor here, and I know you actually flashed on screen one book that you have, Money Masters the Game, Tony Robbins. Phenomenal read. I read it as well. I'm curious to know if there are any other books out there that you would recommend for an investor to pick up today, and if they were, whether just starting out or maybe they're a little experienced, a year or two under their belt, what books would you recommend?
Jack Bogle, The Common Sense of Investing or something like that. It's a red book. As the founder of Vanguard, he probably did more for investors, in my opinion, than anybody. You can put, say, 100 a week, and eventually, you'll have a lot of money, or at least enough to live out your golden years, say. But the Tony Robbins book, it was just such an eye-opener. Like, everything that I did was wrong. And if I just put it in there, I might be kidding myself, but I think I'd have double the money, if I had done it like that.
I read a lot of books, and if I recall, I read that book quite some time ago, but if I recall, and just knowing Tony Robbins, for all the younger bucks who are out there, Tony Robbins was like the master motivator for a long, long while before you had some of these newer guys popping on, YouTube and whatnot. But the name in the game was Tony Robbins, and he always talks about mindset. And I'm trying to remember if that book spoke a lot about mindset in conjunction with finance. But from your perspective, I mean, what no one out there knows, Michael, is it's your time. We started this Masters of the Market chat 5 a.m. and you were already up at 4 a.m. And so the first thing I said to you when you jumped on was, are you an executive? Do you have this executive schedule? You're like, no, I just like to wake up early. And to which I said to you, the early bird always catches the worm. This mentality, or this ability to wake up early and seize the days is really not so average. I'd like to say that, I'm up every morning, 4:30, 5 a.m. I'm running, I'm doing my thing. So it was neat to have someone else on the other side up at that hour. It's unique. So do you think that this attitude towards life, this mindset that you currently have, played a vital role in your financial success?
Yeah, definitely, for sure. I mean, I'm passionate about this stuff. I got a YouTube channel, My Retirement Trading. Basically, I'm just doing a few videos right now talking about things that I invest in. But yeah, I get up early. I read stuff on Twitter. I look at YouTube videos. I got lots of people I follow. Spencer Invest, yourself. This guy named Income Architect, he's got a great channel. Learned a lot from him because he's like a few years older than me. He's completely retired, and his strategies are, seem to relate. And if you're going to look for inspiration from people, it's probably better to find it from people that have been successful, that actually done it. I'm impressed with what I see, like people 25 years old with $250,000 already, like, wow, a lot of them are just in index funds too. And so I'm thinking to myself, like, 6-7 years from now, that's going to be 500. Another, 6 or 7, it's going to be $1 million, and then 2 million, 4. So, I mean, the compounding is just incredible. Cannot stress that enough, the compounding at all. I mean, even if something happened and I had to just live off the cash that I have for a few years, more than likely what I have just in the IRA and the index funds will be double. I'll be a millionaire just off that. Not even if I blew all the money I had. So I guess I'm kind of blunt with it, but that's my take on it.
You know what? It's what I always say though. Like sometimes it's just so simple. We really overthink it. The longer I invest in the market, and don't get me wrong, I absolutely love, doing my own due diligence on companies and looking at their balance sheets and acting, almost as if I was the CEO, and what moves would I make, what decisions would I make. When I'm looking at my money, I want to make sure that, I'm making money over time. And so the one thing that really always comes back to me, if I kept it simpler, right, I wouldn't have any losers, quote unquote, in my portfolio. Right now, I got a big loser in the portfolio. It's United Health. Now, I'm still bullish on it, but when I look at it, I'm like, look at that loss. If I just invested all of that in, like you said, the S&P 500, talk about crazy compounding. I ran the computations on this just the other week. If I took all my money that's in my brokerage account, the brokerage account that everybody can see on YouTube, and I throw all that into a compound calculator and then the S&P 500 in and of itself, by the time I retire at 65, which is the age I put in there, $11 million.
Right.
And a lot of these, big time investors will say it. I've spoken to so many investors on Masters of the Market in the financial world who, when I ask them what they would invest into, most of the time it's actually just the S&P 500. Is it dangerous out there for investors to, I want to say, surf the seas of YouTube and X and even Blossom? Like, as great of communities as these are, it really does seem like the more one comes to find out about investing or discover about investing, it's the simple approach. So is it dangerous to be out there, with information overload?
I wouldn't buy anything just because somebody on YouTube talked about it or anything. I probably, read some good books. Like I said, the Jack Bogle book, Tony Robbins book. And then maybe I would just dip my toes in it to see how it went. But in my opinion, if you just buy an index fund every week, dollar cost average into it, as much as you can afford, don't touch it, no matter what, over time, you're going to get results. And like I said, I probably will convert some of mine over to these covered call deals where I'd probably just take what I needed to live off or travel and put the money back in. But that's later in life. That's not now. I mean, I've bought stuff before and lost money. I've even bought some penny stocks before and lost all of it. It's down to zero. And gone. So I'd rather have something more solid than scratch off lottery tickets, basically.
The scratch off lottery tickets, I never won anything from them. And although I have seen, returns from some individual stocks, none quite like the ones from the simple S&P 500 or a tech-oriented ETF. So with that, investors, I want to invite you, number one, we'll head over to Michael's YouTube channel. I'll have that link down there in the description and pinned comment. But moreover, I want to invite everybody to Blossom as well to get a transparent glimpse into Michael's portfolio, just how simple it really is. You can bet everything on it that the S&P is in there, but he's also got other holdings. So definitely head over to Michael's Blossom portfolio to see what's in his entire portfolio. And until the next go-round of Masters of the Market, it's been an absolute pleasure. Michael, thank you so much for jumping on with us. Investors, we'll catch you in the next one.
Thank you for having me. Appreciate everything. Thank you so much.